ICVS wants to say is what now the new section says. For example, now mark to market losses. Now let us try to understand first what is the concept of mark to market losses. Now suppose I am seller of grapes, I am exporter of grapes. Okay. So today on say 6th of January, I export or I enter into a contract for export of grapes and the delivery is to be in the month of April. Today's dollar rate is 82 rupees and I apprehend that because Indian economy is doing good, that the dollar rate is likely to come down. So it may become 75 rupees or 70 rupees. So what I do, whatever supply, suppose I am going to supply say 1 lakh US dollars in the month of April by way of export of grapes. So those 1 lakh dollars I sell today itself, say at 81 rupees. The selling price is fixed, so my income is fixed because accordingly my cost is fixed. This is more relevant not for the example of grapes but in the manufacture because there is a raw material cost directly incurred as and when the production is made. So in this our example of grapes, I have already booked in the form of a sale US dollars 1 lakh at 81 rupees in the month of April. So come 31st March. What happens? On 31st March, the US dollar is 83 rupees. US dollar is 83 rupees. So I have already lost 2 lakh rupees. If you understand my example, 1 lakh US dollars. Today's price on 31st March, as on the date of closure of the balance sheet, is 83 rupees. Whereas I already sold the dollars at 81 rupees. So I would have realized 83 rupees. So 83 lakhs rupees. I am likely to realize only 81 lakh rupees because I already booked in forward contract 1 lakh US dollars at 81 rupees. Now what is to be done with this 2 lakh rupees? Now this 2 lakh rupees is a mark to market loss because my hedge, my forward exchange contract 2 rupees per US dollar I have lost as is seen. That is I am marking it to the market value of the US dollars on 31st March. Here, as per the various decisions, including there of the Supreme Court, it was stated that this is going by the concept of prudence. This is an allowable loss. Mark to market loss is an allowable loss. But now we have ICVS 1, Disclosure of Accounting Policies, which specifically says that mark to market loss will not be allowed. Now here you have mark to market loss saying ICVS will not be allowed, and you have various judicial decisions saying that mark to market loss will be allowed. Now what does the government do in the budget 2018? Section 36 gets amended, section 43 also 40A gets amended, and section 40A13 says that mark to market losses will be allowed only according to the provisions of section 3618. And 3618 says that new clause, mark to market loss or other expected loss as computed in accordance with the ICVS only will be allowed as a deduction. And ICVS says that it will not be allowed. So this is the example. I am just giving an example as to how the set judicial precedents, JK Sagri decision, JK विशेष एक stability आई हुई, but the department wanted to tax the other way, so they all have been negative. Same thing happens with ICVS 6, effect of changes in foreign exchange rates. In this case, there have been various decisions. They are also subject to section. Now we have new section 43AA. Now section 43AA specifically says that subject to the provisions of section 43A, any foreign exchange gain or loss will be allowed only in accordance with the provisions of the ICVS. That is ICVS 6, effect of changes in foreign exchange rate. So you have section 43AA. Here I was talking about this, that retention money we just discussed. Then also incidental income. When I am executing contract, I generate various incidental income. I am selling up the empty, selling up any waste material, all those income. Typically, as per going by the AS7 construction accounting, I should reduce my construction cost by this incidental income. But ICVS 3 says that this incidental income has to be offered directly as income profit of the business of that year, it is not to be reduced from the cost of the construction. And very importantly, percentage of completion method and project completion method, these are the two methods which can be employed. There have been a number of decisions, including that of Bombay High Court, that project completion method is a proper method, duly recognized method, and one can offer income in the construction contract as per the project completion method. Now, ICDS 3 says that project completion method is not allowed, and you will have to offer income from construction contract strictly as per percentage of completion method, that is POCM method is necessary. And to incorporate all these things which are there in ICDS 3 and ICDS 4, we have now new section, section 43CB, and this contains all with except with duration. It also deals with service contract, not necessarily contracts with material plus labor. It also deals with purely labor contracts, and with respect to purely labor contract also it says that purely service contract, it says that the income has to be recognized as per the percentage of completion method, not project completion method, and they give two exceptions. With the service contract is of less than 90 days duration, then you can apply project completion method. And when a purely service contract involves lot of inputs and intermediate number of acts, then you can offer the income in a straight line method. Straight line method means monthly, quarterly, half yearly. In that method, periodically you can offer the income. So this is section 43CB which comes. Then we have amendment to section 145A. (145A) specifically deals with depreciation scenario and inventory valuation scenario. I am going to deal with this when I am dealing with ICDS 2, valuation of inventory. You have this section 145B, which deals with the various types of enhanced or government compensation, government grants, and whatever is contained in ICDS 7 with respect to government grants, then all is taken care in section 145B, which we are going to see in here. So we have these all sections which came in budget 2018, Finance Act 2018. Now, therefore, the scenario now is plain and simple that whatever judicial precedent which are in contrast with any ICDS, they have now been given backing by these new sections which have got implemented, and therefore the provisions and the income compensation mechanism as prescribed by the ICDA, that will prevail and not the judicial decision. That is what the scenario is. Now let us start with the, so this is the background of ICDS. Now we today, as of now, we stand with all these amendments plus ICDS, and we need to strictly follow the provisions of ICDS while computing the income for income from business or profession or income from other sources, and you are following mercantile system of accounting. Please understand this, that ICDSs are for computation of income from business or profession and income from other sources. They are not for maintenance of books or accounts. The next issue therefore comes to our mind is whether ICDSs apply to assessees opting for presumptive taxation. Section 44AD, 44AE, 44ADA, in particular all these three sections. Now 44ADA is basically for professionals. There we follow cash system of accounting, not a big issue. But 44AE, truck operators, there we are going by per monthly, not a big issue. But when you concentrate on 44AD, that is any other category, eligible business and eligible assessee, then it becomes very relevant as to whether ICDSs are applicable to them or not. And if you see FAQ number 3 of the circular which has told you 10 of 2017, that is 23rd March 2017 circular. If you look at the preamble of the ICDS, the notification of 2016, the notification says that the ICDSs are applicable to all the assessees for computing their income from business or profession, income from other sources, and all types of assessing except individuals and HUF who are not required to get their books of account audited under section 44 AB.